This is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, etc., and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates. And maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. So you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. So the problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare.
The real danger is not that they don't have a trick or two up their sleeve, but that they can't step off the stage. They can't withdraw from market manipulation, policy rate manipulation, money supply manipulation to try to prop up the economy. They would love to kind of go to the sidelines, have what they regard as a theoretically neutral rate, maybe intervene if there's another crisis or another recession, or cool things down if there's inflation, but otherwise just kind of go on autopilot. That's what they would like to do. They can't do that because they're in so deep, they can't get out. Now remember, QE ended in 2014. The interest rates started increasing in 2015, so that was the beginning of tightening. It was very slow at first, but they picked up the tempo in 2017, 2018. And quantitative tightening, I run into people all the time who go, I hate QE. I say, well, sorry, QE was over 4.5 years ago. We're into QT, quantitative tightening. So you were getting a double whammy. They were raising rates 25 basis points every quarter like clockwork, and they were burning money. Remember the famous cartoon of Bernanke hanging out of the helicopter, like a manic look on his face, throwing dollars? That was QE. Picture Jay Powell at a furnace with a pile of $100 bills shoveling the money into the furnace, because that's what they're doing. They're burning money, reducing the base money supply.
We did see this in the 1930s, well, between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration. Then Franklin Roosevelt came in 1933, and Roosevelt faced exactly the same problem. I mean, he shut every bank in America on like his second or third day in office by executive order. He closed every bank in America. Can you imagine the President of the United States today? I don't care if it's Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did to break the banking panic. But he still had the deflation problem, and the Fed couldn't do anything. I talked to Ben Bernanke about this personally because Bernanke wrote a book on this, and I read the book, and I said, Mr. Chairman, I said, here's what I think you said. Did I get this right? And he said, yeah, that's it. You understand it correctly.
The world has been in a depression since 2007 and will remain so for an indefinite period of time. And when you say that, people are, wait a second. Yeah, we know the definition of a recession. The technical definition of a recession is 2 consecutive quarters of declining GDP, rising unemployment. There's a few other bells and whistles. There's a little bit of subjectivity to it. The National Bureau of Economic Research, or the unofficial but widely followed referees on when you're in a recession and when you're not. So they're like, wait a second, how can we be in a depression if we're in the 10th year of an expansion? And the answer is that people don't really understand the definition of a depression. They assume intuitively, well, if a recession is 2 quarters of declining GDP, and a depression sounds worse, it must be 6 quarters of declining GDP. Well, we haven't had that. We're, as I say, we're in the 10th year of an expansion. But that's not the definition of a depression. The definition of a depression is a sustained period of below trend growth with no particular tendency to collapse or getting back to trend. In other words, if trend growth, I'll use the United States, but you can apply this more broadly to the world. If trend growth is 3.5%, and that's probably the long-term potential of the United States. You can higher nominal growth with inflation, but we're talking about real growth. If trend is 3.5, and you're running at 2, that gap between, say, 3.5 and 2, that's depressed growth. So yes, you have growth. You're not in a technical recession. but you're in a depression because you're not getting back to that trend.
We're looking at a global recession, and those are rare. As I said before, it's one thing if Germany has a recession or Japan or the U.S., but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody is declining are rare, and that's what's happening. And that's what we had in 2008. So the U.S. is heading for one. Japan's in a recession. Europe's in a recession. China's in a recession. India's, having some tough times. And a lot of this is dollar related. All the other countries, I mentioned Switzerland, India, China, Japan have all seen their U.S. dollar reserves go down. And everyone's like, oh, they hate the dollar. They're dumping the dollar. No, it's the opposite. They don't have enough dollars. So they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023. And no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think.
And then they ramp up the printing press again, Jim.
Yes, but it doesn't work. $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. The Fed's thinking it could be early to mid 2024 before they even think about cutting rates. That's the famous pivot. So here we see Wall Street in real time kind of bidding on tech stocks because the Fed's going to pivot and cut rates. When in fact, Powell's thinking, no, that's not happening until 2024. So that's what the Fed thinks is happening. The market thinks that Powell is over-tightening, that inflation will come down faster, and the pivot will happen sooner. And that's why we've seen a little bit of a rally in stocks recently. So you have the Fed narrative, that's plan A. You have the market's version of what the Fed's actually doing, which is plan B. My estimate is that they're already past the terminal rate. They don't know it. They don't think so, but they are. And as I said, inflation is going to come down a lot faster than anyone expects.
In summary, the Federal Reserve's biggest nightmare is deflation. While they have always stated that they can handle inflation by raising interest rates, they have no solution for deflation. Raising rates can make deflation worse, and going to zero or negative interest rates has not been proven to provide any stimulus. Additionally, the Fed is so deeply involved in market manipulation and rate manipulation that they cannot withdraw from it and go on autopilot. This is a problem that was also faced during the Great Depression of the 1930s, and even then the Fed couldn't solve the deflation problem. We hope this video has provided you with a clear understanding of the challenges the Fed faces when it comes to deflation. Thank you for watching.